Hello everyone, I'm Kunal Sodhani from Global Trading Center Shinhan Bank India, and we are here to decode and unfold the domestic factors, global trends, understanding both the aspects clearly and having a view on several currency pairs. So first, talking about the domestic factors, let's talk about the trade deficit numbers. The trade deficit number for the month of December 2023 came in at around $19.8 billion. Also, if we talk why this number is lower, because of the lower imports due to easing of commodity prices and certain rising global demand pushes the exports higher by 1%. Breaking down into year specific, for 2022 we had this trade deficit of around $108 billion, and for 2023 we have this same number at $69 billion. So definitely we have seen the trade deficit narrowing by almost 36% on a year-on-year basis. But if break down this into understanding what are more nitty-gritties, then first understand about our trading partners. For the first 7 months of 2023, we had deficit out of 10 trading partners in 9 trading partners. Only US was one country where our exports exceeded our imports. Also, if we talk about Europe, nearly 80% of our merchandise trade happens with Europe also, which happens through the Red Sea. But due to the Yemen's backed Iran's Houthi militants, where there has been some kind of attacks since last 3 months ongoing, which kind of creates some kind of supply side disruptions also, and the cost of freight and insurance also going higher, which can definitely have an impact on inflation and in turn obviously on the current account and trade deficit numbers also. But talking about current account deficit numbers, we expect it to widen by 1.5% for Q4 2023-2024. Now let's talk about flows more in detail, because flows have definitely helped the FX reserve also gone higher. For the year 2023, we had seen a tremendous flow of 1.71 lakh crores, which is the historical highs India has ever seen. Going ahead in 2024, we expect these flows to continue, though there can be some kind of consolidation in flows, but we still remain optimistic considering the budget and election still on the picture to go around. But if we break down into flows, what are more important parameters to consider is the corporate earnings from here on, because the corporate earnings can be a decider of is the euphoria actually in sync with the corporate earnings, or is there any kind of divergence seen. So corporate earnings are quite important to watch out. Secondly, it's quite important to watch out the trajectory on the rates, because now people are following a very cautious approach, particularly for a shorter and mid-term tenor. Considering how much of rate cuts are expected, would there be an aggressive cut? Some kind of cool off has been seen on those fronts, and now the aggressiveness has gone bottomed out to some extent. Thus, a cautious approach may be followed by investors when it comes to flows. Also, two important parameters to understand is the JP Morgan flows, where they have announced inclusion of government bonds into their index of GBI-EM Global Index Fund. And if this obviously when happens from June 2024, breaking down into 10 quarters incrementally 1% each, we anticipate an inflow of around $24 billion from that side. Similarly, if we talk about Bloomberg, they have also proposed inclusion of government bonds in their global aggregate index, but it's just a proposal at this point in time. But if this happens, their proposal is to have a 5-month tenor with a 20% incremental increase starting from September 2024 to January 2025. If this happens, we can see an inflow of around $15 to $20 billion. So if we sum this up, and if this really comes a reality, particularly from the Bloomberg side, which acts as a proposal as of now, we can see an inflow of around $40 to $45 billion in the second half of the year, now which is a whooping inflow considering India. Now, if we break down why is it beneficial for India, because borrowing cost pressures can be very minimal. It can also help us finance the fiscal as well as the current account deficit. So this is from the flows perspective, but let's now just link this to the FX reserves. If we see the current FX reserve standing at around $618 billion, and the all-time highs was around $645 billion, which was seen in October 2021. But from where we have bounced in last 2 months, from almost a low of $529 billion to currently around $618 billion. Why this has happened? All the inflows which we have been catering to have been very smartly managed by the Reserve Bank of India and acting as a counterparty to those flows. What happens by this? Obviously, without much depreciation of rupee, we are able to onboard more FX reserves into our kitty. Why this is important? It is important because the uncertainties which may prevail considering a lot of elections, not only in India, but if we talk about US presidential elections, elections in Taiwan, South Korea, Ukraine, Russia, UK. So there can be kind of uncertainties due to which we need to have our import cover in place. and our external debt also under cover, due to which this reserves can be very beneficial to us. But if we go to the manufacturing PMI and the services PMI index, the manufacturing PMI index is stating around 54.9 versus 56, the earlier figure. Now the breakup of this is quite important to watch. The new orders and the output actually softened as compared to unemployment, delivery time and the items purchased. Because of the top two priorities which contribute to 55% of the weightage of the manufacturing PMI survey, we saw a drop in the manufacturing PMI. But on the contrary, when we talk about the services PMI, it grew to 59. And all the parameters were in sync. We talk about sales, we talk about employment, inventories, prices, all supported to the rise of the services PMI. So we were quite positive on that front. Now talking about the RBI policy and what do we anticipate, it's important to understand the CPI number, which is at 5.69%, which is the recent print. Why it was important to watch out is, first let's talk about the core inflation. The core inflation softened to 3.8%, which is almost a 4-year low versus 4.1%. But is it important that the core inflation remains sticky, or is it important to check will this continue to be a trend where the core inflation will be lower? As of now, no, because considering how the December month has panned out, we see the inflation still rising, and our anticipation for the next month is around 5.88 to 5.95% of inflation as a CPI number. So personally, considering the CPI number, we believe that the rate cut possibly remains a bit distant at this point in time from RBI perspective, and we do not eye any rate cut in the first half of this year. If we talk about the budget now, because budget is the immediate important event which is lined up, which is due on Feb 1st. What exactly are the key points we look forward for? We look forward for breakup of populist measures, or is it fiscal prudence? So there is a tightrope between them. Is it about economic sensibilities, or is it about voter aspirations? We see it more towards from the economic sensibilities, and we see the focus will remain on several sectors like digitalization. It can be the public-private partnership. It can be more on the realty sector. It can be also focused more on the green revolution or the EV space or the renewable energy, if we put it in one goal. So these kind of focuses will be there, where India as a nation will attract more FDI as well as FII flows considering the budget. Also, if we talk about the election criteria, which possibly the dates are not yet finalized, but April or May is the tentative dates which are in sync with the expectations from the markets, then it's quite important to see first what happened in September 2023. We had 3 states where we had a sweeping success by the BJP government, and considering those successes, particularly Rajasthan and Madhya Pradesh, the bigger ones, considering that states, now there is a clear sentimental change where the anticipation is that possibly the market still considers BJP to be as a front runner with a clean sweep in the Lok Sabha elections also. If this happens, it can be a vital change, because since 2014 till date we have seen a lot of positive changes. Also, why other reasons could be possible is some reasons have been assigned and associated with a lot of years back, and which have turned the tides in the last 3 to 4 years. Particularly if we talk about the Air Force having the Balakot strike in retaliation of the Pulwama, which was a surprise and very positive side, which was not seen earlier. If we talk about the Ayodhya, 500 years later, we have had religious criteria which plays a vital role in terms of the voters' share. Also, if we talk about how the GDP has fared for the country, so in 2014 we were ranked 10th in the world in terms of our GDP, and now we have grown to 5th position in 2023-2024. So considering the pace at which we are going, considering the pace at which we are attracting the FII flows have been quite tremendous. But only talking about FII flows may not be right, because it kind of acts as a hot money which can come and go. But it's also important to understand the FDI, because if we talk about the FDI amount, it has been at around $10.1 billion, which is multi-decadal lows. So I remember we have seen this number in 2007, 2008, after which these have dried up a lot. And what's the reason of this drying up? This drying up is because the ease of doing business is still remaining a bit complex, and there still remains red tapeism. Also, India has scrapped their bilateral investment treaties with the other countries. And the third important factor is the FTA agreements which we are signing. So particularly with Australia, we started UAE, and now we are looking forward to sign the FTA agreements with US, EU and UK as well. So this remains an important element to watch out for. But let's move on to the global factors now, that what exactly is happening on the global front, which can also have an impact on our domestic macros also. So talking about Brent crude prices, which is quite important because India being a net import, or maybe around 70% of oil imports India is having. So it's quite crucial to talk about Brent. Brent crude prices are actually hovering around $80 per barrel. But conflicts in the Middle East, the Russia-Ukraine crisis still going on, and the supply side and the demand side impact has been also there from the inventories perspective. So we feel that $72 per barrel may act as a base in terms of Brent crude prices, with the resistance coming at around $83 per barrel, followed by $97, which was a recent high. So Brent crude prices, one important consideration to not to miss on. Second, it's also important to understand what and exactly is happening in China and the Chinese yuan. So if we talk about the Chinese yuan, it has been hovering around 7.15 to 7.20 levels. Our personal view from a technical perspective is 705 may act as a base, with 728 on acting as a resistance. But why? Because there is a lot of deflationary pressure out there. And if you see the other countries, they are having problems with inflation rising. Here it's the other way around. Inflation is dropping because the demand itself is a problem out there. The real estate is still a problem out there. The debt is almost 25 to 35% of the GDP purely only from the real estate. So China still remains a black box to understand. How do we fare? So, but its ignorance cannot be permitted when we come to our currency pairs also. Now let's talk about dollar index. If we break this into what Fed is thinking, what was the pivotal role, and what the dot plot suggested. The dot plots initially suggested 3 rate cuts for the year 2024, but the market was quite aggressive, anticipating 6 to 7 rate cuts also for the year 2024, which definitely cooled off when the Fed speaker started commenting their hawkish stance, considering inflation possibly still remains a bit persistent. If this goes, then obviously the rate cut trajectory may not be to that extent of what the markets are anticipating, which obviously has its impact on the 10-year US Treasury yields and on the dollar index. On the dollar index, we expect 100.80 to act as an important support zone, while 105.80 acting as an important resistance. While on the 10-year US Treasury yields, the yields have started rallying from probably a recent low of 3.8% to around 4.2% now, because the anticipation of rate cuts have softened again. So 10-year US Treasury yields 3.8 remains as an important base, but as and when the rate cut actually turns into picture, we may see it flowing lower, but at least some knee-jerk reactions towards 4.25 to 4.5 band can be seen once, like a trigger, and then cooling off sharply. Now let's break into the macros of other currency pairs which are important to watch out. First, talking about the euro dollar, the President Christian Lagarde was very clear about her stance that they are not eyeing any kind of rate cut until summer, and that too if the data is supportive. So euro dollar seems to be in a consolidation phase and may not be the first mover when it comes to rate cut. They may wait for Fed action and then possibly define how do they strategize themselves in terms of rate trajectory. So considering that, the levels which we are expecting is 1.0720 acting on the lower end, and on the right side 1.1120 remains the brighter side for the euro dollar pair. If you go to the GBP dollar, that is UK, then they have their own problems, particularly if you see the retail sales number, they have been drastically lower, which creates a lot of concern on that perspective. Plus the February policy, we don't anticipate any kind of rate movement or rate cut from their side also. Still anticipate it to be in a range of 1.2480 on the left side and 1.2880 remaining an important resistance on the right side. So the consolidation still continues to be there. Talking about dollar JPY, that is Japanese yen, we anticipate it to be in a very broader range, because the volatile currency like JPY can have a 3 to 4 biggie move in a single day. So considering that, we feel 139.80 may act as an important support. 150 can be protected at this point in time. Their policy still remains on the status quo. There is no change on the yield curve policy and no concerns at this point in time with the rate hike on their perspective. So that's from the dollar yen perspective. Now let's understand what an exporter should think, what an importer should think, what is our view on dollar rupee. So first let's understand what do we feel on dollar rupee and why till March 2024. So understanding March 2024 and the history which we have seen, Obviously, it's being a financial year end, a lot of corporates would obviously want to highlight a very healthy balance sheet. And for that, the demand for INR increases, which in turn acts on the appreciation side for the rupee. May not be necessary, but the trend suggests that. With this into mind and the rate cut trajectory also in mind, which we're not anticipating any change here, the important aspect to watch out will be immediately the budget and what kind of inflows does it attract immediately. And apart from it, it's also important to watch out how Brent crude prices behave and any kind of escalation is seen on the Middle East or the Red Sea crisis getting escalated from here on or no. So taking those into cues, we anticipate 82.20 to act as a support till March end, because we see more of inflows lined up, and on the right side 83.60-65 band acting as a very important resistance. If we break down into what an importer and exporter should do from here on, the market has been quite kind, giving an opportunity to both importers and exporters. If we talk about a very narrow range which we have seen is 82.80 on the left side and 83.35 on the right side. So this is a narrow range where both an importer as well as an exporter are getting an opportunity. But talking about first importers, as we see a bit of more appreciation bias till March end, then if levels of 82.80, we are seeing those levels once again, it's important where an importer can start hedging his exposure. Also, the forward premiums are lower, which actually is in his favor at this point in time. So with lower forward premiums, anywhere between 82.5, 82.80 levels, it's a good way to start the hedging perspective, also in a very diversification manner. So it's not important to hedge at one level, but if we break down into maybe 30-40 paisa ranges, then obviously it plays an important, the hedging cost of the importer may be lower. On the exporters front, we anticipate that we have been seeing levels of 83.30 to 83.40 revisiting couple of times. And if these levels come, it's not important to the top of the range. It's not easy. And obviously, it's not a business for a corporate also to do so. Their business is purely mitigating the FX risk. Considering that 83.30, 83.40 remains a very good zone for an exporter to hedge at least around 40% of his exposure and remain open for his 60% exposure with possibly a mental stop loss of 80 to 60 is what we suggest for an exporter also. So this was the global perspective. We also covered the domestic perspective. Hope was insightful and it actually adds value to you. Shinhan Bank is very thankful for your time. I am the host Kunal Sodhani, once again thanking you for your time, and in case of any queries, any suggestions or any feedbacks with respect to the view and analysis, please feel free to contact us. Thank you so much.